Your brain treats a 30% portfolio drop with the same neural intensity as a physical burn, triggering a survival response that prioritizes immediate exit over the 8.2% historical returns of the S&P 500. While the average equity investor captured only 1.9% annually over 2 decades due to this biological hijacking, the most successful accounts belonged to those who were literally unable to react. The following systematic moves transition your strategy from fragile human intuition to an automated firewall designed to protect your wealth when your cortisol levels are highest. Consider the chaos of 2020, when the global market plummeted 34% in a staggering window of only 23 trading days. While most investors scrambled to mitigate the damage, a specific cohort of individuals emerged as the undisputed champions of the crash. They were not the most sophisticated analysts or the quickest traders. According to data from Fidelity, the highest performing accounts belonged to people who were either deceased or had simply lost their passwords. Their success was born from an absolute inability to interact with the volatility. While everyone else was busy reacting, these stationary accounts were protected by their own inactivity. When the markets crater, the human impulse to intervene is often the very thing that destroys wealth. The cost of this intervention is laid bare by a Dalbar study spanning a 20-year period that included the 2008 financial crisis. During that time, the S&P 500 delivered a robust annual return of 8.2%. However, the average equity investor managed to capture a meager 1.9% annually. This massive wealth gap was not a result of picking the wrong companies or sectors, it was the direct consequence of behavioral failure. It is the tragedy of buying into a peak alongside the herd and selling at the bottom when the psychological pressure becomes agonizing. These are perfectly logical actions taken by people who are trying to be sensible, yet they prove to be perfectly catastrophic for their net worth. This failure is not a lack of intelligence but a matter of biological hardwiring. Research from Stanford's neuroeconomics lab reveals that when we witness financial losses, a specific part of the brain called the anterior insula is activated. This is the same neural real estate that processes intense physical pain. Watching your portfolio drop by 30% is not a mathematical exercise for your mind, it is the neurological equivalent of slamming your fingers in a heavy car door. Your brain does not see numbers on a screen, it senses a visceral threat to your continued existence. When this survival alarm sounds, the brain initiates a singular, frantic command to flee immediately. The rational, analytical software we use for long-term planning is abruptly overridden by an ancient operating system designed to escape predators in the wild. You are no longer a modern investor calculating dividends, you are a panicked organism trying to survive a crisis. This is why even the most brilliant minds make devastating errors during a market rout. They are being guided by an evolutionary reflex that was optimized for physical safety, not for managing the complexities of a 401k rebalance during a global recession. To combat this, you need a framework of moves designed for the version of you that wakes up at 2 a.m. in a cold sweat, watching global futures bleed red. This is not about the calm person who reads finance books on a quiet Sunday. It is about building a system that remains functional when you are terrified and desperate to do something, anything, to stop the bleeding. The goal is to ensure a temporary market dip does not solidify into a permanent financial ruin. The first and most vital defense is the automation firewall. We are told constantly to stay the course and keep investing when prices fall, yet there is a vast, turbulent river of stress hormones separating that intellectual advice from actual execution. You might know what to do, but your body is screaming at you to stop. Data from the University of Chicago Booth School of Business highlights the power of removing human choice from the process. During the 2008 crash, investors who automated their contributions ended up with 73% more wealth a decade later than those who stopped their deposits to wait for a better time to re-enter. They won because they never gave themselves the opportunity to make a choice. By establishing automatic transfers into your investment accounts, you lock in your strategy before the panic has a chance to take the wheel. The strategy for surviving a market downturn requires moving beyond mere intent. You must execute your rebalancing and capital transfers through an automated architecture that exists entirely outside of your daily decision-making process. By establishing these systems once and deliberately engineering obstacles to prevent easy modifications, you create a safeguard against your own future impulses. Some savvy investors go so far as to house these automated systems in separate banking institutions, ensuring that any attempt to halt the strategy during a crisis necessitates significant friction, such as making an actual phone call or navigating a complex manual process. This structural rigidity is necessary because willpower functions exactly like a battery that loses its charge over time. This concept was substantiated in 1998 by psychologists at Case Western, who proved that our capacity to resist immediate impulses is a finite resource. When the market descends into chaos, your emotional regulation centers consume every available watt of mental energy. You are left with virtually no psychological fuel to maintain financial discipline. Automation acts as a mechanical proxy for character. It does not require you to find courage or possess an iron will in the middle of a storm. It simply requires you to have acted before the clouds gathered. Accepting this necessity is not a confession of weakness, but a recognition of human nature. When the anterior insula of the brain is firing at full capacity, rational thought is effectively locked out of the cockpit. Furthermore, you must establish a dedicated cash buffer zone. This is not capital tied up in brokerage accounts that requires several business days to settle. It is cold, uninvested liquidity sitting in a high-yield savings account. The target for this reserve should be enough to cover 6 to 12 months of your living expenses. While this might seem like an unproductive drag on your portfolio, the psychological shift it provides is a total game changer. Research from Princeton University has demonstrated that the sensation of financial scarcity creates a cognitive tax, stripping an individual of 13 IQ points. This drop represents a functional shift from high-level reasoning to a state of cognitive impairment. Without this liquid cushion, you are essentially trying to navigate a financial crisis while being intellectually handicapped by your own anxiety. The presence of these funds transforms your mental clarity. According to a study from the Federal Reserve Bank of St. Louis, families who maintain even a modest amount of emergency savings are 2.5 times less likely to succumb to panic-driven financial errors when the economy turns sour. This liquidity creates what behavioral economists call decision space. It provides the breathing room necessary to avoid catastrophic mistakes at the exact moment the market reaches its nadir. The true value of this cash buffer is its ability to soothe your nervous system. Knowing that the rent is secure and the grocery bill is paid prevents your brain from entering a full survival-based shutdown. It allows you to remain a detached observer of the chaos rather than a victim of it. Although keeping a large sum in a savings account may feel like a waste of potential growth, it is the most brilliant move you can make because it preserves the mental faculty required to build long-term wealth. It feels like waste, but it is not a waste. An extra $200,000 in wealth can be generated by a single habit, yet most investors ignore it because it feels like walking into a burning building. This financial maneuver is disciplined rebalancing, which Vanguard's investment strategy group found added roughly 0.35% in annual returns between 2008 and 2012 compared to portfolios left to wander. While a fractional percentage sounds negligible, when applied to a $500,000 portfolio over a 30-year horizon, it compounds into a massive fortune. Most treat rebalancing as a dry, yearly clerical task for tax season, but in the heat of a market collapse, it functions as a mathematical gravity well that pulls you toward profit. Consider a standard target allocation of 80% stocks and 20% bonds. If a sudden crash wipes 40% off the value of those stocks, your portfolio's internal chemistry shifts to 67% stocks and 33% bonds. At this moment, every survival instinct you possess will demand that you retreat to the safety of fixed income to stop the bleeding. However, the path to wealth requires you to do the exact opposite: liquidate your stable bonds to purchase more of the plummeting stocks. This is psychologically agonizing because you are essentially doubling down on the source of your stress. It is why you cannot trust your own judgment in real time. You must eliminate the need for a debate with your survival instincts by setting percentage-based triggers. By automating the process so that any asset drifting more than 5% from its target triggers a trade, you remove the human element entirely. There is no sitting at a computer wrestling with your internal fears, the system simply executes the optimal move that your emotions would otherwise veto. The danger of a market crash is that it rarely remains contained within your brokerage app. As seen during the 2008 financial crisis and the industry-wide shutdowns of 2020, market volatility eventually spills over into the real economy and threatens your primary paycheck. When your net worth is evaporating and your job security is simultaneously vanishing, the resulting desperation leads to catastrophic errors, such as liquidating retirement accounts at a 40% loss and incurring an additional 10% penalty. This is a total breakdown of financial logic driven by a lack of alternative options. To prevent this downward spiral, you must build strategic redundancy into your personal economy. Research from the National Bureau of Economic Research proves that households maintaining more than one income stream are 4 times less likely to touch their retirement savings during a recession. This has nothing to do with working yourself to exhaustion, it is about psychological insurance. Having varied cash flows ensures that if one pillar of your income collapses, the others provide enough structural support to stop a total collapse of your strategy. This is about strategic redundancy. Aside income from freelancing, rental income from a property, dividend income from a portfolio you've been building. A singular income stream acts as a dangerous bottleneck for your entire financial existence. When you rely on one solitary paycheck, your subconscious correctly identifies it as a fatal structural vulnerability. This deep-seated awareness is what transforms a standard market correction into an all-consuming personal emergency. You do not need to replace your entire salary with side ventures to gain peace of mind, you simply need to create enough of a supplemental cash flow that your mind stops interpreting every negative economic headline as an immediate threat to your survival. By diversifying your intake, you essentially install a secondary generator for your household, ensuring that the lights stay on even if the main grid experiences a blackout. Furthermore, you must recognize that active news consumption during a panic is a direct drain on your net worth. Data from the University of California, Berkeley, reveals a stark reality. Individuals who digest financial media daily during volatile periods trade 40% more often than those who check their accounts only quarterly. This hyperactivity is a financial death sentence, slashing annual returns by an average of 1.5%. Over a 30-year career, this behavioral gap on a $400,000 portfolio results in a staggering loss of over $300,000 in potential wealth. This isn't the result of market movements, but a self-inflicted tax caused by a lack of information hygiene. The media landscape during a crisis is not engineered to provide clarity, it is weaponized to spark an adrenaline response. The MIT Media Lab established that emotionally charged financial headlines travel 6 times faster than objective, neutral reporting across digital platforms. You are not consuming journalism, you are subjecting yourself to a high-frequency psychological assault designed to trigger your fear reflex. To counter this, you must implement an anti-news protocol. This means restricting portfolio reviews to once a month, limiting financial reading to a single summary per week, and purging all news notifications from your mobile devices. By deliberately remaining less informed of the minute-by-minute chaos, you become a far superior investor. This tactical silence protects the automation firewall you built earlier by removing the siren song of reactive trading. Finally, the transition from merely surviving a crash to achieving generational wealth requires the creation of an opportunity fund. This is capital distinct from your emergency savings, earmarked specifically for aggressive acquisition when asset prices collapse. While the broad public recognizes the famous Warren Buffett mandate to be greedy when others are fearful, the execution remains a rarity because most lack the liquid means to act when the moment arrives. This fund provides the logistical teeth to bite into discounted assets when everyone else is paralyzed by panic. Warren Buffett's most famous quote is, "Be greedy when others are fearful." Everyone knows it. Almost nobody does it. The neural architecture of the human mind is essentially rigged against the investor. Research coming out of Cornell's Department of Human Development highlights a startling physiological reality. Our brains process potential gains and potential losses through 2 completely separate neural highways. Because of a phenomenon psychologists call loss aversion, the sting of a financial hit registers roughly 2.5 times more intensely than the joy of an equal profit. When the S&P 500 is bleeding and down 35%, your rational prefrontal cortex might logically conclude that equities are trading at a steep discount. However, your emotional centers are simultaneously howling that any further investment is a step toward total ruin. This emotional voice possesses a higher degree of neurochemical authority and processes information with much greater speed than your logic, meaning that in a street fight between your feelings and your math, your feelings almost always emerge victorious. This biological bias is why the implementation of an opportunity fund is so transformative. By setting aside capital specifically destined for market downturns, you bypass the emotional veto. You are not making a high-stakes choice in the middle of a panic, you are simply executing a series of commands you wrote for yourself when you were calm and collected. You have already determined the price levels and the specific assets to target. This disciplined approach is backed by Harvard Business School data on institutional investors. Their findings show that those who utilized predetermined crisis deployment strategies beat out reactive peers by an average of 3.2% every year in the 3-year window following a major market collapse. That 3.2% spread is not just a rounding error. When compounded over decades, it represents the tectonic shift between retiring at age 60 or being forced to work until 67, and the difference between bequeathing an inheritance to your children or leaving behind an empty ledger. There is, however, a psychological tax you must pay to maintain this fund. It requires the stomach to let cash sit quietly in a savings account earning a modest 4.5% while your neighbors brag about 12% returns during a roaring bull market. It is the social equivalent of sitting out an exuberant celebration and feeling like a fool for missing the fun. But that isolation is the price of admission for the moment the cycle turns. When the music stops and everyone else is desperately trying to exit the room, you are the only one with the resources to walk in and buy. When you synthesize these 6 strategic moves, a clear pattern of systemic defense becomes visible. None of these tactics require you to possess a higher IQ, a specialized finance degree, or access to an expensive Bloomberg terminal. The real secret to navigating market chaos has nothing to do with superior information or better market predictions. It is about building a cage for your own worst impulses. You are constructing a framework that functions precisely when your brain stops working, automation to replace failing willpower, cash reserves to dampen the roar of fear, and rigid rules to prevent emotions from seizing the controls. It is time to stop viewing financial panic as a character flaw. Wanting to liquidate everything and shove your cash into a floorboard isn't a sign of weakness. It is a sign that your brain is functioning exactly how it was designed to. You are operating with a mind optimized for a primitive world where threats were immediate, physical, and demanded instant flight. That ancient hardware is magnificent at keeping you alive in the wild, but it is fundamentally incompetent at managing a modern retirement portfolio. These 6 moves do not attempt to rewrite your biology. Instead, they accept that you will be terrified and irrational at the worst possible times. They create an environment where, despite your fear, the right financial outcome happens by default. The solution to market volatility is not found in more discipline, but in the creation of better systems.